I think that's the key here. When it comes to investing, everything is about time horizon. So the question nails it on the head. If you need the money in 5 years, you are in a short time horizon. And we would not want to invest any of our client dollars in equities if they need them in less than 10. Next question from YouTube. What is the minimum years you would suggest to keep the money in money market versus stock market? Is it okay for me to save money in money market for home purchase down payment in 5 years? Absolutely. Absolutely, it's okay. And absolutely, I would say in 5 years, you certainly wouldn't want to save that exclusively in the stock market. Now, there are other options in between no risk and more risk,
right,
that you might want to look at. But certainly with where interest rates are right now, it might make sense to keep that in CDs or in a money market. And when she says money market, now it depends on the interest rate there. There might be more attractive interest rates in other options as well.
Yeah, there are a couple things that I would say here. Obviously, a money market account is going to pay you interest. Money market accounts are not FDIC insured. However, they do pay a very solid rate of interest, and they are very stable in terms of value. A certificate of deposit, if you know the time frame in which you're going to use it, in this case 5 years, you could probably look at that as an option. Another thing you could potentially look at is maybe the bond market. There is maybe some opportunity if interest rates start coming down for there to be some appreciation on top of the coupon rate or the interest that bond portfolio might be paying. So you could come out better there, but you do have a degree of risk there, albeit small risk in terms of bonds, but you do have a degree of risk there, Scott, that you may or may not want to take depending on how critical it is to have that set amount of money at a particular time in the future.
Yeah, I think that's the key here. When it comes to investing, everything is about time horizon. So the question nails it on the head. If you need the money in 5 years, you are in a short time horizon. And we would not want to invest any of our client dollars in equities if they need them in less than 10. We would say 10 to 15 years is the long-term investment strategy that you should have, the long-term investment mindset that you should have if you're going to enter the stock market. A great example of how this works, history shows the most successful investors in equities buy it and leave it alone. Warren Buffett is a great example. Warren Buffett is not a day trader, John.
That's right. And there are things that you can really take a look at in terms of probabilities of return in the market. We'll get to that in our next question, I believe. But Scott, I think that the one thing that you want to think about is in terms of equities, you don't want to invest anything in the stock market that you're going to need in less than 10 years. That's just my personal rule, is that I don't invest anybody's money in the stock market if they're going to need it in less than 10 years, because you have no idea what's going to happen. You have no idea how that volatility will play out in terms of the timing of your need for that money. That's why we talk about it in the Income for Life model being a long-term, more aggressive position for 15 plus years down the road in your retirement, to allow those equities time to do what they do, and that is grow over the long term.
I think this is a good time to show that graphic. I think Casey has it for the probability of positive returns in the stock market. Now when we say the stock market, we're using the S&P 500 index, what everybody does. It's just the 500 largest companies in the United States, roughly, and it is an index. You can't invest directly into it. But if you look at the returns of the S&P 500 index since 1937, there is a 53.4% chance that it's going to be positive in any given day. Goes up to 63% chance in a month, 69.5% chance over 3 months, and over 1 year you got a pretty good shot, 77.5%. And over a 3-year term, 87.3%. But if you need money for a down payment in 5 years, I don't think you want 87%. You want 100% that you're going to have at least every dollar you started with. And as you see, you get to 5 years, you're really looking good. But you get to 10 years, you believe the probability of 97.3% of it being positive over a 10-year time frame. That is where you want to hang out.
Scott, I've been known to play a hand or two of blackjack, and one of the things that I would love to be able to do is stack all the cards in my favor. I would love to know exactly how those cards are going to come sequenced to me in a blackjack game. Sure. That's just the basically the rules of the game. But when you're investing, what you want to do is you want to stack all the cards in your favor. What do I mean by that? Let's go back to that graphic for just a second if we can, Casey. Take a look at that 10-year time period. 97.3% of the time, looking back since 1937, if you held an investment in the S&P 500, 97.3% of the time, it's been positive in terms of return. Well, north of 10 years, I think you're pretty much stacking all the cards in your favor.
Yeah.
You know you're going to get a positive return because history has told us that, that's how the market acts. Now, I have to qualify that and say past performance is not necessarily indicative of future results, but you can look at how the market behaves and get some consistency of its performance. And so when you look long term, then you stack all the cards in your favor of possibly having a positive return regardless of when you actually invested.
This is our question of the week. We want to say congratulations. We're going to send you a free Get Ready for the Future show tumbler for being named the question of the week, but we need you to tell us how to send it to you. Email us. Email it to show@getreadyforthefuture.com and claim your free tumbler. Thanks for the question.